on our own, we can't reach and serve all the markets that we want to serve. We understand that fintechs play a significant role as a technology enabler. However, the challenge is that oftentimes fintechs are not.
And I'm going to highlight the three things that I talked to RC about that I think were critical to us becoming comfortable with investing.
It itself presents a challenge, but another challenge that frankly blew my mind is the continent sometimes cannot get it out of its own way. So let me explain. Last week I was in
See the sunrise in the morning glow. People hustling, moving to and fro. Money flies with the speed of light.
Panel. My name is Marlon Brown. I am principal at Clarendon Global Partners, which is an investment advisory and private equity firm focusing on the continent of Africa. And so happy to bring this panel to you, and thank you for the IIN crew in putting together this panel and having us all here together. We're going to have a discussion around capital and investments, mobilizing that for the continent of Africa, and with our distinguished panelists. I'm going to give them a chance to just kind of introduce themselves. They'll do a much better job than I would in telling you what they do, and we'll get started after that. So why don't we start here with Bryan?
So I'm Bryan Baggenstos. I work with KC Family Programs. We're focused on improving the foster care system and outcomes for foster care youth in America. But we have a large endowment that we invest. We're very globally focused, and we've invested on the continent for decades now, actually for at least a decade. And we go wherever we can to get the money to support the children.
Good. Very good.
Kola, Aina. I am the Senior Vice President for M&A, Business Growth, and Strategic Partnerships at Mastercard. To Bryan's point, I think most of you already know Mastercard. We do quite a lot all over the world. I'm going to save some time in going into details. My understanding is that our bios are already up there somewhere. But my team essentially focuses on trying to support fintech innovation across multiple levers. So we have 4 strategic pillars that we use. We have like an early stage accelerator type program. We have minority investments as a strategic pillar in which we put in a little bit of money to support them. We focus on commercialization with the fintechs. And then we also have actual M&A acquisitions where if a fintech fits into our strategic pillars and they bring in some incremental value, then we look at a full-on acquisition. On the other side of the house, with a Chinese wall, we also have the Mastercard Foundation that does a lot of stuff across Africa in particular as well. So we'll talk a little bit more about those as we go along.
Good morning. Adi Divgi, founder and chief investment officer of Divino Global Holdings, based out of New York. 2-decade career in financial services. The last 14 have been on the private markets allocation side. 3 years at New York City Pension, 7 years at Catalina, a private reinsurance company, 2 years at an independent wealth manager. And I set up Divino Global in April of 23 as an investment management and advisory firm focused on under-the-radar private funds. We started looking at opportunities in Africa almost a decade ago and established our portfolio in 2020. I'll talk about 2 of those portfolio companies today.
Great. Thank you. So in my 30 years of investment management, institutional money management across many spheres, one of the things that's always had an interest for me is African continent. I started investing and visiting the continent 25 years ago. One stat I saw recently is that although private capital has fallen 25% in terms of the raise of capital, it's actually soared and increased over the last few years to $4+ billion. So clearly although there is a falling of capital raised, there is quite a bit of capital that is still growing and going towards the continent of Africa. I think I'll start with Kola, and if you would just tell us what you look for and how you operate in terms of evaluating investments on the continent.
Yeah, thanks, Marlon. So two things. One, I'll speak from a Mastercard perspective, and being a true son of the soil. I'm originally of Nigerian descent. I also invest in Africa personally as well, so I'll talk a little bit about that. But from a Mastercard perspective, we have three strategic pillars in terms of how our business operates. We're a network, we're not an issuer, we're not a merchant or an acquirer or processor. But what we recognize is that on our own, we can't reach and serve all the markets that we want to serve. We understand that fintechs play a significant role as a technology enabler. However, the challenge is that oftentimes fintechs are not well positioned to work with large institutions like MasterCard. That's what we find to be the biggest challenge. And so, what our teams tend to focus on right now is looking at fintechs that have achieved product market fit, as well as how we can enable scaling and commercialization. And like I said earlier, we have a number of strategic levers that we use. So if you think about a fintech that's in its early days, say, pre-seed, seed round, 2 years or less in operations, that is going to be a very good candidate for our Start Path program. This is a program that brings in the fintech in a structured, organized way, gives them exposure to multiple lines of business across MasterCard over a period of time in a very structured manner. At the end of that period of time, depending on what they do, how they've modified what their go-to-market operations are going to look like, we or one or two of the various business lines may decide there's something here that we'd like to work with them on, and then we provide what could be akin to seed capital. It's not really seed capital, but we do provide capital, less constraints, a lot easier for us to deploy capital in that way. We deploy that capital off balance sheet. For those of you who are in financial services, you kind of understand what I'm talking about. Now, the next lever is we look at actual minority investments. Now, this is a little bit more tricky because we do not lead any investment round. So we're always looking for a venture or a fund manager to lead the investment round, and then we come in as a strategic in that investment round. Initially, we sit back and just kind of wait until the fintech is able to find the lead. But what we found is that when we do find interesting companies and they are unable to find a lead, we have a very large ecosystem of fund managers that we work with. And so what we've now started to do is to actually make introductions to some of these fund managers. So yesterday I was in New York. Many of you know this is Fintech Week in New York, and I had one such company in which they were looking to do something very creative that we were interested in, but they didn't have a lead investor. So I went to that, fintech conference. I met with a number of the fund managers that we work with, and the interesting thing is that these are not necessarily fund managers that are resident in Africa. Many of them are resident here in the U.S. and in North America. In fact, this particular one is in Toronto, but just like, most venture fund managers now, they're looking to explore opportunities beyond the immediate geographic terrain. And so we make the connection, they have the conversation, and it typically goes something like, hey, Kola, are you going to be interested in coming in if I lead this round? And it's like, yeah, we've had preliminary conversations. Here are the commercialization opportunities that we're looking at with this particular fintech. If you agree to lead the round, then we will come in as a strategic on the back end of that. And so we provide not just capital, but we also provide reach, we provide guidance, and a whole bunch of other things. But I don't want to take up the entire time, so I'm going to defer. I'm happy to have conversations, later on as a sidebar to kind of talk a little bit more about how we actually operationalize, how we organize around these.
Very good. Thank you so much. And then just so you know, we're going to leave a few minutes at the end of the panel just for some audience Q&A, so you'll get a chance to address some questions to the panelists. Advi, why don't we come to you and talk about how you approach the continent and why you approach the continent. And I think sometimes that's helpful for some of us to remember that there is quite a bit of return to be obtained from the continent when we think about it in the context of risk return. But why don't you tell us how you approach investing there?
Sure. So almost a decade ago, we started looking at the continent primarily as an allocator into funds. Initially, we looked at it as having primarily focused on the U.S. and Western Europe. We started looking at emerging markets, including developing Asia as well as Africa, as next sources and less correlated sources of total return. The part of the challenge with investing in funds is, particularly in Africa, is the currency issue. We didn't end up moving forward on any fund commitments, in part because of that reason. How we ended up deciding to get exposure to the region actually was through our private investor and family office relationships. I wanted to thank Zacharias and Bintu of IIN for allowing me not only the chance to speak here, but also for allowing me to invite Kareem Sharif of Majlis, who introduced one of our portfolio companies to us, the CEO, Michael Aldred, who happens to be here today as well. So thank you to both of them for joining us here. Michael has a company called Kofisi, based out of Nairobi. They provide customized workspace solutions for multinational corporations looking to enter the continent. They set up the company approximately a decade ago. We made our commitment in 2020. Initially based in certain countries, they've expanded recently to include a larger number of countries within the continent, but have been very tactical in their approach, focusing on the demographic trends and the rise and interest of multinationals towards certain cities within the continent relative to others. Another company that Kareem and I co-invested in is Baobab Network, which focuses on providing first check capital into early stage companies across the African region. And Fintech is one of their focus sectors as well. Frankly, as a private investor and wealth manager, we do not have the resources to set up a tactical investment program in directs globally, much less in a region as diverse as Africa. And I think it's important particularly since this panel is entitled U.S. Africa Institutional Partnerships, for a large amount of education to be presented and shared with the U.S. community. Before I started looking at Africa, like perhaps I suspect many other U.S.-based investors, looked at the region as a monolith, one broad culture, one broad way of doing things. When I started looking at Kofisi and Baobab, I understood that it's actually the complete opposite. The continent consists of 54 countries, God knows how many cultures on top of that, and hundreds, if not thousands, of individual languages and dialects. I think that itself presents a challenge, but another challenge that frankly blew my mind is the continent sometimes cannot get it out of its own way. So let me explain. Last week I was in Marrakesh for GTEx Africa. One of my panelists there was based out of Cairo. A show of hands. Morocco is 4 countries away from Egypt. How many people in this room think that the gentleman flew directly from Cairo to Marrakesh? A show of hands. How many people think that he flew through Europe to get to Marrakesh? Blew my mind. He had to go through Zurich. I think that is just emblematic of the challenges that Africa faces in getting out of its own way and enabling greater efficiencies to be sought within the continent itself. Until basic infrastructure is provided to enable trans-country travel within the region, rather than the inefficiency of having to go through the colonial masters, I think it's going to be very challenging for us to take the next step within the innovation spectrum to grow and enable the continent to thrive. I think that's part of the reason why we've been a little reluctant to increase our exposure. Instead, we're looking to develop our connectivity through opportunities like this, meeting established individuals like yourself who are more active in the region, building up a knowledge base, and then making a decision to proceed with next steps.
Great, thank you, Adi. Bryan, we'll come to you. And the Casey Family Foundation, it's interesting that part of your portfolio is dedicated to investing on the continent. Can you give the audience a sense of why that is important in terms of your structuring of your investment portfolio? And then secondarily, how you go about looking at investments on the continent. In our audience, I think there are people that will be interested in hearing how they can maybe procure an investment from Casey.
Yeah, definitely. I mean, we have a very global view on investments right now. That's extremely pertinent given the stuff happening in the United States, and it's been very beneficial so far this year. And you can't have a global view without including Africa as part of that. And so we do spend a lot of time. We don't have a dedicated allocation to any region or country. Everything competes pari passu with everything else. But we have spent a lot of time on the continent in various different countries looking at
Do you
opportunities.
set a percentage of your portfolio dedicated, let's say, to emerging markets, or?
We are overweight to emerging markets. We have about 5 or 6% of the portfolio in emerging markets right now. But when I say that, I'm thinking of emerging market equities. But a lot of our exposure in Africa comes through real estate, through private equity, even through fixed income. So it's kind of blended across the portfolio. We do allocate, as you mentioned. We're allocators to funds. We're looking at one co-investment, but even then we're relying on those fund relationships that we have. And so I would highlight, I just got approval in the IC last week on an investment in Africa with a fund, and I'm going to highlight the 3 things that I talked to RC about that I think were critical to us becoming comfortable with investing in this fund. First of all, I'll just tell you the 3 things, and then I'll talk a little bit about them: people, structure, and currency. And so, first of all, the people. We wanted to make sure that that we knew who the key person was that was driving returns, driving the investment decisions. We knew that they were long-term focused, what their vision was, and that they were aligned with us as an international investor. We wanted to make sure they had the experience and the capability to do what they were doing, and that they were in this for the long haul. And we were impressed with that on this fund. Some of the things they were doing showed that they wanted their firm to extend beyond themselves, and that was important to us. Second, structure. When we looked at this is a private equity focused manager that actually is doing more and more mezzanine debt types of structures in their deals. That was important because it gives some downside protection, it gives some early cash flows back to LPs, and it gives an exit, right? And exits have been an issue. So it gives you an exit platform at the onset of the investment. And then the third thing was currency. And currency is a big one because we see fund after fund where the local currency returns look fabulous and the U.S. dollar returns are 0 or less, right? And so understanding the currency issues and making sure that they understood the currency issues and that they were concerned about them. Again, going back to people, they realized that in order to achieve the vision that they need for this fund, they need international investors, and so they were very aligned with those U.S. dollar returns. Their compensation was aligned with the U.S. dollar returns, and they had an understanding within their structures that dealt with currency, and as well as getting money and capital back to LPs quickly so that it's not exposed to the potential devaluations. So those were the 3 things that we highlighted, and I think that's what got us comfortable with this fund. This is a manager that we are looking at doing some co-investments with as well. It's really important to us to have people who are on the ground who know the area and can help give us that insight.
Great. That's a nice overview. Just one quick question that comes to my mind. In terms of currency, which is so important on the continent, Casey wouldn't ever hedge the currencies as it relates to its portfolios. You kind of rely on the managers to do that. Is that correct?
That's right. There's a cost to hedging, and we don't want to be the ones. If the manager feels like that cost is worth taking on, then we give him that opportunity, but we're not going to overlay it.
Great. Kola, I think it would come back to you, and if you can give us just some examples of, one of the things is tales of success
Yep.
on the panel. And we all have had success, but we know Africa can be difficult. Can you give us a couple of examples? And Addie, I'm going to ask you the same. I think you highlighted some already, but just some success stories and some of the things that you considered in mitigating some of the unplanned elements that could come up in these kinds of investments.
Yeah, that's a really good question. So I'm going to give an example, not exactly a fintech because it's a slightly larger organization. We are a public company, so things that are in flight, I can't speak to. But the one that is public, I'm going to speak to. I think most of you already know that we made an investment in MTN, which is the GSM network out of South Africa. That was several $1 million. Now, Advi and Bryan talked about concerns around currency and other things. For us, we are a strategic investor, so we do not have those concerns. When we make investments, we're not necessarily making that investment for a cap return. And I think when I spoke earlier, I talked about the need for African entrepreneurs to understand how to relate and engage with a strategic investor like ourselves. When we make an investment, we're looking for ways to commercialize that particular investment. So with MTN, for instance, we were looking at their network. And we wanted to be able to use their network to reach places that we were otherwise unable to reach. I think many of you know that here, broadband access to the internet is almost ubiquitous across most of North America. In Africa, not always quite the same. And our network relies on connectivity. So we can't process a transaction if there is no connectivity. And so when we were looking at that particular investment opportunity, we were looking at it in terms of how do we leverage that to get to and reach and establish connectivity in areas where we would otherwise not be able to, particularly in rural areas. Now, we became aware of this because of a program that we have, which originally started in Kenya. I think many of you know this, which was an offline program, Mastercard Pass. Many of you may have heard about it, that was designed to allow local agriculture or farmers to be able to engage in commerce and trade in a way that even if they didn't have direct network connectivity, they could still conclude their transactions. So those are some of the motivations. We have partnerships with M-Pesa and a few other fintechs across the continent as well. And the underlying thing for us each time we look at these types of opportunities is how does this enable us to deliver our core service? And our core service really comes down into three buckets. One, which is the network, which is enabling the transaction. Two, delivering services on top of the network, which could be fraud, identity, and other type services. And then the third piece is enabling cross-border transactions. In terms of how we think about risk when we look at investment opportunities on the African continent, again, we think of risk as an input into the system. So we are going to simply account for it the way that we would account for and model out any other aspect of the transaction. So we don't necessarily think it's more risky or less risky. We will assume or attribute a cost to managing that risk, and we build that into the model in terms of how we operate. But remember that ultimately what we're looking for is entrepreneurs or fintechs that have achieved product market fit, and therefore the need for them to deliver a certain return is less of a concern because we're essentially taking their capability or their distribution network and scaling it within our customer base. Right. So for instance, if we look at like M-Pesa, for instance, we know that they're a money movement solution, and we have issuers who are looking to expand their cross-border reach, and being able to tack that capability on is something that we would do quite easily. So the monetization or the commercialization of the opportunity comes from our customer base versus necessarily the customers that that particular fintech might be serving. So we do lean a little bit more heavy in terms of the capability, and we're not quite as concerned about the quote-unquote cap return as you would. And, you talked about allocations. We don't have an allocation. We have like a rolling fund that we do on a biannual basis that we replenish, and we use that and operate within that context across all the regions that we operate in.
Great. That's a great overview of what you do. One of the things you said in the beginning was just connecting smaller entrepreneurs with larger ones in terms of fitting into your strategic space. Edvi, are there sectors that are specific that you are more intrigued by and would be more prone to consider in your investments?
What we're spending a significant amount of time now evaluating, in addition to fintech, is health tech or medical technology, as well as agricultural technology or ag tech. Those are areas where we don't yet have investments in Africa, but have made investments in developed markets and are looking at how those types of models within developed markets can be either customized within Africa or tweaked to fit the necessary countries within the African mold more effectively. Touching on the tales of success, because I had briefly talked about the two portfolio companies where we have Africa exposure, but let me discuss Kofisi in particular, because when we made our investment in 2020, the company was raising capital primarily at the management company level to fund its operations. One of the reasons, and to touch on both of your issues regarding currency as well as ours, one of the reasons we got comfortable with making our investment into the company is they funded themselves primarily in dollars, U.S. dollars. So even though they have operations across the region, their liabilities and their investor base is primarily coming through in hard currency, which made us more comfortable, but also enabled them to have far more flexibility in their financial operations as they expanded and increased their country footprint across the continent. Another successful mechanism that they employed after we made our commitment in 2020 is to develop a project finance model rather than a management company or holding company finance model only. So the project finance complements their ability to raise at the management company because it enables them to get specific funds for a specific project within a specific city in Africa. So one of their first projects was near their headquarters in Nairobi. They started getting pre-lease from multinationals, including a German development finance institution. Eventually, firms like Apple, Amazon, and Google have also joined on to be tenants of Kofisi's in Nairobi and elsewhere. But I think that raising for a specific asset rather than the broad holding company was part of what led to greater success for the firm.
Great. Thank you so much. I did say I'd leave a few minutes, a couple of minutes for some audience questions. So just think about that. Maybe we could take two questions, but I just wanted to end with Bryan in terms of, are there sectors that you are particularly interested in versus others?
We don't really focus on sectors. We focus on asset classes, and we, as I said, we have fixed income, we have real estate, we have private equity, and we have equity investments on the continent. And so across the board, and then we look to our managers to allocate to the various sectors and companies. So we do find that supporting the middle class is very appealing because that middle class is growing, and there's a lot, and the demographics I think was mentioned earlier are incredible in Africa. We wanted to support that and take advantage of that.
Great, good to know. Two questions. So we have one here, the gentleman with the, yeah. Yes.
Thank you. My question is for Kola. Thank you very much for your commentary. But what would be helpful for me, given the vastness of your experience, what was your biggest regret in looking at the continent from an investor's perspective, from a strategic investor's perspective?
That's a really good question. So I'll answer it from our organizational standpoint, which is that we, like most other either fund managers or strategic investors, assumed that there wasn't much value in making these kinds of investments or commitments on the African continent. I think that was the biggest, if you look back, probably strategic error. I think the way that we've attempted to correct that is to bring in talent that has better understanding of the African continent, as well as give a little bit more regional latitude to different aspects of the organization that are engaging with the African continent. So our minority investment and strategic partnership is much more regionalized. It's not driven out of North America. It's driven primarily out of the African continent, which sits within our Eastern Europe, Middle East region. And I think as a, person of African descent or Nigerian descent, I was pleased to see that evolution of a better understanding, but I just think it's a lack of understanding, that same monolithic viewpoint that, Africa was a single entity or single, geographic, place to do business versus the fact that there was unique differences across multiple areas. And the fact that, people assumed, and we also assumed, that it was very risky. But I think over the years, we've found that it is not quite as risky as we originally assumed. So I would say that our biggest regret was, one, just that being not informed and assuming that there was more risk than there really was, and not making the effort to customize our engagement model to address the specific nuances of that region, which we are now doing.
Great. Thank you so much. I think we're actually out of time. So I'd like to thank our panelists again for this engagement, and I'd like to thank Bintu and IIN for putting all this together. Thank you so much.